Imagine minting like $5 billion in a single quarter from just one single disease category.
Yeah, it's almost hard to wrap your head around.
Right. I mean, you own 52% of the entire U.S. market. Your profit margins are literally jumping by hundreds of millions of dollars. You are, for all intents and purposes, printing money faster than you can even spend it on your daily operations.
Firing on all cylinders, basically.
Exactly. And yet, you have to get on an earnings call, look your retail investors right in the eye, point to the 2026 balance sheet and say, we are actually going to post a net loss for the entire year.
It is the ultimate paradox.
Welcome to the totally bizarre, high stakes accounting world of Gilead Sciences.
I mean, if you're a retail investor who just uses standard stock screeners, it's completely baffling. You see this top line revenue number that suggests an absolute juggernaut of a company, right? And then you glance at the projected earnings per share and
it looks like they're, burning the office furniture just to keep the lights on.
Right. But if you actually dig into the mechanics of what Gilead is doing right now, that red ink, it's not a sign of distress at all. It is literally the cost of buying the future of medicine.
Which is exactly what we are going to tear apart today. We are diving deep into Gilead's Q1 2026 earnings call. And if you're joining us, you know our Talk Tickers framework. Our goal here isn't just to read you a boring press release.
No, nobody wants that.
Exactly. We are going to decode the Wall Street jargon. We're going to pull apart the actual, the hardcore biology of these massive pipeline bets they're making and separate the short-term accounting noise from the long-term cash flow.
Because that's what actually matters for your portfolio.
Right, because when you look under the hood of this massive biopharma giant, they are attempting a corporate pivot that is honestly almost unprecedented in its scale. They are trying to fund this multi-billion-dollar shopping spree in oncology and cell therapy, and they're doing it using the ultra-reliable cash flows of their HIV business.
Yeah, and that transition, it's just perfectly reflected in their top-line numbers. I mean, if you just look at the raw data right off the bat, first quarter total product sales came in at $6.9 billion.
Which is huge.
It is. That's up 5% year over year. But that 5% number is actually incredibly deceiving for investors because it includes Veklury.
Ah, right. Veklury, that's their COVID-19 antiviral drug, right?
Yeah, exactly.
And Veklury is essentially just, pandemic runoff at this point. With hospitalizations thankfully way down, sales of Veklury are dropping pretty rapidly. I think, if I remember the transcript, management projected it to only do about $600 million for the entire year of 2026.
Yeah, that sounds right. It's fading out.
So if you are an investor, you really shouldn't be pricing Gilead based on this temporary antiviral spike. You have to strip Veklury out completely to see the real underlying health of the company.
Right. You have to look at what management calls the base business. And this is where the picture gets super interesting. So if you take COVID out, the base business hit $6.8 billion for the first quarter.
Okay.
And that translates to a massive 8% year-over-year growth rate.
Wow.
I mean, for a mature mega-cap pharmaceutical company to move the needle 8% on nearly $7 billion in a single quarter, that requires just incredible operational leverage. It basically means their core franchises, HIV, oncology, liver disease, they're all just firing simultaneously.
But wait, I have to push back a little here because I was looking at the sequential numbers in the transcript.
Right.
Like comparing Q4 of last year directly to Q1 of this year.
Okay, yeah.
If the base business is booming at 8% year over year, why did sales drop 12% sequentially? I mean, a 12% quarter over quarter drop looks like a massive red flag on a spreadsheet.
Yeah.
Did underlying patient demand just fall off a cliff in January?
No, it looks alarming. I totally agree. But this is actually a textbook quirk of the pharmaceutical supply chain. Joanna Mercier, who is Gilead's chief commercial officer, she's specifically called this out as Q1 seasonality and inventory drawdown.
Okay, but we need to explain the mechanics of what that actually means because, inventory drawdown usually sounds like corporate spin for people stopped buying our product.
Fair enough. It's actually driven by wholesale purchasing behaviors and rebate structures. So think about a massive pharmacy benefit manager or a huge national pharmacy chain in November and December. They often buy this massive bolus of drugs right in the fourth quarter for a couple of reasons.
Like end-of-year quota stuff.
Exactly. First, they might be trying to hit these specific volume-based rebate tiers with the manufacturer before the calendar year ends. If they buy an extra $100 million of drugs in December, it might trigger a retroactive discount on their entire year's purchasing.
Ah, okay. So they're essentially just hoarding inventory to maximize their own profit margins.
Precisely. And furthermore, pharmaceutical companies historically raise the wholesale acquisition cost of their drugs every January. It's like clockwork.
Right, the annual price hike.
Yeah. So if you are a wholesaler, you obviously want to stockpile as much inventory as possible at December prices. So because of this artificial fourth quarter hoarding, Gilead's Q4 sales numbers always look artificially inflated.
Oh, I see. So then when January and February roll around, those pharmacies are just dispensing the massive stockpile they already bought and shoved in their back rooms in December.
Exactly.
They don't need to place new orders with Gilead, so that is the inventory drawdown. Yeah. That 12% sequential drop isn't a drop in actual patients taking the drug. It's just the pharmacies working through their back stock.
You nailed it. The patients are still taking the exact same number of pills every single day. It is purely a timing mismatch of cash flows between Gilead and the middlemen. It's totally normal, completely anticipated by management, and not a systemic failure in the slightest.
Okay, that makes total sense. Good to clear that up.
Yeah.
Now let's talk about the profitability, because man, this is where the numbers really jump off the page. Their non-GAAP diluted earnings per share, their EPS, came in at $2.03 for the quarter.
Very solid.
Which is a really solid 12% year-over-year increase. Mm-hmm. But the metric that absolutely stunned me was the product gross margin. It hit 87%.
Yeah, that's huge.
That is up 2 full percentage points from a year ago. I mean, in a business doing nearly $30 billion a year, a 2% margin expansion is a staggering amount of cash just dropping straight to the bottom line. So where did that come from? Did they just suddenly get way better at manufacturing pills?
No, it actually wasn't an operational efficiency at all. It was a legal and contractual expiration.
Wait, really?
Yeah, Andrew Dickinson, the CFO, he explained that this massive margin jump was primarily driven by the expiration of a historical TIAF-related royalty obligation.
Okay, TIAF being tenofovir alafenamide, right? Which is like the backbone ingredient in almost all of their modern HIV medications.
Right, exactly. So decades ago, when Gilead was developing the early precursor to TIA, they partnered with various academic and third-party institutions. And as part of those development agreements, Gilead owed those partners a percentage of the revenue, a royalty for every single pill ever sold that contained that specific intellectual property.
Wow. So for years, every time Gilead sold a bottle of Biktarvy or Descovy, a slice of that cash had to be paid out to these third parties.
Yep. It's essentially like having a business partner taking a 2% cut of your gross revenue for 20 straight years.
And that contract just naturally hit its expiration date.
Exactly. The patents and the associated royalty obligations finally hit their contractual end date. So suddenly, that 2% leak in the bucket is permanently plugged. The revenue coming in from the pharmacies is exactly the same, but Gilead gets to keep hundreds of millions of dollars more of it every year.
That is just pure, unadulterated profit expansion without having to sell a single extra pill. That is the dream scenario for a shareholder.
It really is.
But, the obvious next question for an investor is, what are they doing with all that extra cash? Because when I look at the spending dynamics for Q1, their R&D expenses, research and development, held relatively flat year over year at about $1.4 billion. But their SG&A, the selling, general, and administrative expenses, that jumped 12%. And usually, Wall Street hates seeing SG&A rise faster than R&D because it suggests corporate bloat.
It can suggest bloat, absolutely. But in this specific quarter, that 12% jump is actually highly strategic. It is the marketing muscle being deployed for the launch of Yes2Go.
Ah, their brand new HIV prevention drug.
Right. They are funding a massive direct-to-consumer marketing campaign. Because when you launch a drug that fundamentally changes the entire paradigm of treatment, you can't just rely on doctors to remember to mention it during a 15-minute checkup.
You have to go directly to the patients.
Exactly. You build awareness on TV, on social media, and you drive them into the clinic specifically asking for it by name.
Which brings us perfectly into the core engine of Gilead, right? The HIV juggernaut. Because we can talk about their cancer aspirations all day long, but HIV is the cash cow paying the bills.
Oh, absolutely, without a doubt.
Gilead's total HIV business grew an incredible 10% year over year to $5 billion just in the first quarter. To grow a mature legacy franchise of that massive size by double digits is almost unheard of.
And the undisputed heavyweight anchor of that franchise is Biktarvy. It pulled in $3.4 billion in Q1, which is up 7% year over year. We really need to just pause for a second and appreciate the sheer dominance of this single drug. Biktarvy commands more than a 52% market share in the United States.
52%.
Yes. Think about the gravity of that number. More than half of all people prescribed an HIV treatment regimen in the entire country are taking this exact pill.
It's essentially a monopoly within a highly competitive space. But why? Why is Biktarvy so impenetrable? Like, what makes it the default choice for so many physicians out there?
It comes down to a really important concept in infectious disease treatment called the barrier to resistance, combined with extreme tolerability. So Biktarvy is a single tablet regimen that combines 3 different drugs, including a very potent integrase inhibitor.
Okay.
The virus has to mutate in incredibly specific and mathematically improbable ways to escape Biktarvy's mechanism of action. Furthermore, it has a very clean safety profile regarding kidney and bone density issues.
Which I know is a huge problem with the older generations of HIV drugs, right?
Right. The early drugs were really tough on the body. So for a newly diagnosed patient, what they call a naive patient in the clinical space, Biktarvy is just the safest, most effective, and easiest default choice.
But they aren't just resting on Biktarvy, which is interesting. They have a massive pipeline catalyst coming up in August. A PDUFA date for a brand new combination drug called BicLen.
Yes, August is going to be a big month.
And just a quick reminder for anyone listening, a PDUFA date is the strict deadline for the FDA to make a final approval decision on a new drug. So BicLen is a combination of Bictarvy, which is the core of Biktarvy, and a new drug called lenacapavir.
Right.
But my question is, if Biktarvy already owns 52% of the market and works incredibly well, why do they even need to launch BicLen? Aren't they just going to cannibalize their own sales?
That's a great question, but they aren't actually trying to cannibalize Biktarvy at all. They are trying to capture the final stubborn 5 to 6% of the HIV population that Biktarvy simply cannot serve.
Oh, interesting. Who are those patients?
There is a small but really critical subset of patients who are highly treatment experienced. Meaning over decades of being on various older medications, their specific viral strains have developed severe resistance to the standard regimens. These patients are technically virally suppressed, which is good, but they are stuck taking incredibly complex multi-tablet regimens.
Like taking a handful of pills every day.
Exactly. We are talking 5, 6, 7, even 8 pills a day. And they have to be taken at different times, some with food, some on an empty stomach. It is a massive daily logistical burden.
Not to mention just a constant daily reminder of their illness.
Exactly. And that's where lenacapavir comes in. The new component in BicLen is what's called a capsid inhibitor. It works in a completely different biological way than any previous HIV drug on the market.
Okay, break that down for us. How is it different?
Well, instead of stopping the virus from replicating its DNA inside the cell, it literally binds to and disrupts the protein shell, the capsid that protects the viral core itself.
Oh, wow.
Yeah, and because it's a totally novel mechanism, the virus has absolutely no pre-existing resistance to it.
So the ARTIS 3.1 and 3.2 trials that management talked about, those were designed to see if these highly treatment-experienced patients could drop their handful of daily pills and switch to just one single tablet of BicLen.
And the data from those trials was phenomenal. They demonstrated that BicLen maintained viral suppression in these super complex patients with no clinically meaningful emergent resistance.
That's incredible.
Right. So while BicLen isn't going to unseat Biktarvy for the average newly diagnosed patient, it allows Gilead to capture that final, difficult-to-treat 5% of the market. They are effectively monopolizing the entire spectrum of HIV treatment.
It's an incredible quality of life upgrade for those specific patients. But as fascinating as the treatment market is, the numbers that truly blew my mind in this transcript were actually on the prevention side.
Oh, the PIP numbers?
Yes. The U.S. HIV prevention business known as PIP, or pre-exposure prophylaxis, skyrocketed by 87% year over year. I mean, an 87% growth rate for a decades-old pharmaceutical vertical is staggering. It reads like a hyper-growth software startup, not a pharma company.
It really does. But the PIEP market is undergoing a fundamental renaissance right now. I mean, for years, the market grew steadily, driven by drugs like Truvada and then eventually Descovy.
Right. And Descovy, which is their daily oral pre-EP pill, still did great. It hit $807 million for the quarter, up 38%.
But the entire landscape is being reshaped by their newest asset, Yes2Go. This is their brand new, long-acting injectable pre-OP. Q1 sales hit $166 million, which is up 72% sequentially from just the fourth quarter of last year.
That sequential leap is wild. That proves this isn't just some slow incremental rollout. It is an explosive adoption curve. I was trying to think of a way to describe why Yes2Go is such a massive paradigm shift. It's like cutting the cord on cable.
That's a good way to put it.
It's not just a new drug, it's a completely new behavior. Because for years, the reality of pre-AP was just a daily grind. You have to remember to take a pill every single day. If you miss a dose, your efficacy drops. There's a heavy psychological weight to taking a pill every morning. It's a constant nagging reminder of risk.
And Yes2Go removes that entire psychological burden. You get an injection once every 6 months, and you simply go live your life.
That psychological shift is exactly why the adoption metrics are so aggressive. But to get an injectable drug to explode like this, you have to remove the commercial friction, right? Because injectables are notoriously expensive.
Oh, incredibly expensive.
They require a clinic visit instead of just a trip to the local pharmacy. And insurance companies usually fight tooth and nail to require patients to try cheaper generic pills first.
Right, the dreaded step therapy.
Exactly. But Gilead has executed what looks like a masterclass in market access here.
They really have. I mean, the coverage numbers they shared on the call were astounding. They noted that 95% of individuals now have insurance coverage for Yes2Go in the U.S.
It's almost universal.
But the more important stat, the one that really drives the volume, is that of those 95% who are covered, 95% of them can access Yes2Go with a $0 copay.
That's the craziest part to me. A brand new, highly innovative, patent-protected injectable with zero out-of-pocket cost for the patient. How on earth did Gilead manage to pull that off against the insurance companies?
It is a calculated, highly aggressive commercial strategy. Gilead is heavily subsidizing those copays right now through their own patient assistance programs.
So they're footing the bill.
Yeah. They are willing to eat the short-term cost to ensure that when a patient asks their doctor for Yes2Go, the pharmacy doesn't reject it based on price. They want massive, rapid market penetration. They want to make the 6-month injection the absolute new standard of care so quickly that insurance companies basically have no choice but to add it to their primary formularies.
And it's clearly working. They noted that Yes2Go is completely dominating the switch category. Which makes sense, people abandoning their daily Descovy pills for the convenience of the injection. But what really surprised management was the naive user base.
Yes. People who have never been on pre-P before are choosing Yes2Go as their very first intervention.
It suggests that the daily pill was actually a massive barrier to entry for a huge segment of the population that wanted protection but didn't want the daily routine.
Exactly. The total pre-EP market actually grew 14% year over year. That means the pie itself is getting much bigger, and Gilead is taking the lion's share of that new growth. And the persistency rates are also highly encouraging.
Meaning people are actually coming back for their second shot.
Yes. When it is time for that second injection 6 months later, patients are actually returning to the clinic to get it. The adherence is incredibly sticky.
Management is so confident in this trajectory that they did something you rarely see this early in a product's life cycle. They aggressively raised the 2026 full-year guidance for Yes2Go from $800 million to a full $1 billion.
Yeah, they're telling Wall Street point blank that this will be a mega blockbuster drug in its very first full year on the market.
It is a massive flex, and it solidifies pre-EP not just as a side business, but as a multi-billion-dollar pillar right alongside their treatment franchise.
But the craziest part of this whole earnings call is that a 6-month injection isn't even their end game.
Right. Dietmar Berger, the chief medical officer, spent significant time outlining their future pipeline, and they're pushing the boundaries of pharmacology to almost like a science fiction level. They are actively running trials to stretch the duration of these drugs even further.
It is a relentless pursuit of convenience. They discussed the Island 1 and 2 trials, which are evaluating a once-weekly oral pill for HIV treatment.
Once a week.
If successful, that would be the first ever long-acting oral regimen. The pharmacokinetics required to make a single pill slowly release active drug into the bloodstream over 7 days without peaking too high or dropping too low is incredibly complex.
Then there is the GS3242 integration. This is an investigational integrase inhibitor they are pairing with lenacapavir. Phase 1 data has already shown potential for dosing every 4 months, and they have higher dose cohorts ongoing right now. They could push that to a twice-yearly injection for actual HIV treatment. Not just prevention, but actual treatment. Imagine taking a disease that used to require a dozen pills a day and reducing it to 2 shots a year.
It's miraculous. But the crown jewel of this pipeline, the trial that really demands our retail investors' attention, is the Purpose 365 study.
Oh man, yes. Enrollment is completely finished for this phase 3 trial. They are testing a once-yearly intramuscular injection of lenacapavir for pre-FP. I want to pause here and make sure everyone listening understands the mechanics of that. How is it physically possible to inject a liquid into a human arm or glute and have that drug actively protect against a virus for 365 days? Does it just sit in the muscle?
It is a total marvel of formulation science. They don't just inject a standard liquid. They use what is called a depot formulation, specifically a crystalline nanosuspension.
Crystalline nanosuspension. That sounds intense.
It is. When it's injected into the intramuscular space, the drug forms a highly stable, tightly packed depot. It's almost like a microscopic crystal reserve sitting inside the muscle tissue. And because of the specific chemical properties of lenacapavir, it is incredibly hydrophobic.
Meaning it repels water.
Right. So the body's fluids can only erode and absorb the very outermost layer of this crystal depot at an agonizingly slow rate. It just slowly leaches these nanodoses of the active drug into the bloodstream, maintaining a steady protective trough level for an entire year before the depot is fully dissolved.
That is unbelievable. It's like a titanium lockbox of medicine sitting in the muscle, just dispensing a microdose every single day for a year.
That's exactly what it is. And they are targeting U.S. approval for Purpose 365 in 2028.
We are definitely going to circle back to the broader societal implications of this in our bottom line, because if chronic disease management shifts from a daily pill to an annual injection, the entire psychology of healthcare changes. But first, we have to talk about how Gilead is spending all this massive HIV cash, because they're aggressively trying to build a second empire in oncology and cell therapy.
And that pivot into oncology is currently anchored by Tredelvi. First quarter Tredelvi sales hit $402 million, which is an impressive 37% year-over-year growth.
What's driving that nearly 40% growth rate? Is it just broader adoption by doctors, or are they moving into new patient populations?
It's really both, but the major catalyst is their push into earlier lines of therapy. So Tredelvi is already firmly established as the leading regimen in second-line metastatic triple-negative breast cancer, or TNBC.
And TNBC is a notoriously aggressive form of breast cancer, right? Because the tumors lack estrogen, progesterone, and HER2 receptors.
Exactly. That means traditional hormone therapies and targeted drugs like Herceptin are completely useless against it. But Tredelvi targets a different protein called 2OOP2, which is overexpressed on these specific cancer cells.
So already succeeding in patients who have failed their first round of standard chemotherapy. But the real money in oncology is always in the first-line setting.
Exactly. And recently, the NCCN, the National Comprehensive Cancer Network, gave Tredelvi a Category 1 recommendation across first-line metastatic TNBC.
Now, I see NCCN guidelines mentioned in almost every single biotech earnings call we cover. But for a retail investor trying to understand market penetration, what does a Category 1 recommendation actually mean in practice? Does it, force doctors to prescribe it?
It doesn't legally force them, but it is the absolute gold standard of clinical consensus. A Category 1 rating means there is uniform agreement among the top oncologists in the country that this intervention is highly appropriate and backed by undeniable, high-level clinical evidence.
Got it.
Practically speaking, it means insurance companies will almost never deny coverage for it. And community oncologists who, remember, treat the vast majority of patients, will adopt it as their default standard of care. It perfectly sets the stage for Tredelvi ahead of formal FDA approval decisions for the first-line setting, which are expected in late 2026.
So Tredelvi is the foundation of their cancer business. But a $400 million quarter is small change compared to what they're aiming for. Gilead hasn't just been quietly funding internal R&D to build their pipeline. They have been on an absolute multi-billion-dollar shopping spree. Let's talk about the Tubulus acquisition first, because this dives deep into the world of ADCs, or antibody-drug conjugates.
ADCs are arguably the hottest sector in all of oncology right now. I mean, for decades, the standard of care for cancer was traditional systemic chemotherapy. But chemotherapy is incredibly blunt. It targets any rapidly dividing cell in the body.
Right, it kills the cancer, but it also destroys hair follicles, the gut lining, the immune system, which is why the side effects are so devastating.
Exactly. And ADC is an attempt to solve that toxicity problem through precision engineering.
Right, an ADC essentially consists of three distinct parts: the antibody, the payload, and the linker. The antibody is like a bloodhound. It is engineered to seek out and bind only to a very specific protein found on the surface of the cancer cell while ignoring all the healthy cells. The payload is the toxic chemotherapy drug, and the linker is the chemical bridge that connects the toxic payload to the antibody.
And historically, the linker has been the absolute Achilles heel of ADC development. Older ADCs were essentially like delivering a toxic bomb in a flimsy cardboard box during a rainstorm.
That's a great analogy.
The linker wasn't stable enough in the bloodstream. It would break apart prematurely, releasing the highly toxic payload into the general circulation before the antibody ever reached the tumor. This caused massive systemic side effects and severely limited the amount of drug you could safely give a patient.
Which is exactly why Gilead just bought Tubulus. Because Tubulus didn't invent a new antibody or a new toxin. They invented a new box. They bring a proprietary linker technology called the P5 platform.
The P5 linker is a massive biochemical breakthrough. To use your analogy, it replaces the cardboard box with a titanium lockbox. The P5 linker creates an incredibly stable chemical bond that is practically impervious to the enzymes and conditions found in the general bloodstream. It simply will not break apart in transit.
So wait, how does the drug ever get released to actually kill the cancer?
That's the genius part. The P5 linker is specifically engineered to only dissolve in a highly acidic environment. Once the antibody binds to the cancer cell actually swallows the entire ADC in a process called endocytosis.
Okay.
It pulls the ADC inside itself into a cellular compartment called a lysosome. The lysosome is highly acidic and full of specific enzymes designed to break things down. Only in that specific, highly acidic environment inside the cancer cell does the P5 linker snap, releasing the toxic payload directly inside the cancer cell, destroying it from the inside out while leaving the healthy neighboring tissue completely untouched.
That is an incredibly elegant mechanism. So along with that P5 platform, Gilead acquired Tubulus's lead clinical candidate, a drug called TB40. But I want to inject some skepticism here, because during the Q&A portion of the earnings call, an analyst basically challenged management on the price tag. Why pay billions of dollars for Tubulus when there are dozens of ADC companies out there right now? Are they overpaying for a crowded technology?
It's a fair question. Management aggressively defended the valuation, though, based on the clinical data presented at the recent ESMO Oncology conference. TB40 is currently being tested in platinum-resistant ovarian cancer. This is a notoriously aggressive, difficult-to-treat disease with incredibly poor survival rates. The early phase 1 data for TB40 showed objective response rates that were not only remarkably high, but they actually deepened over time. The tumors continued to shrink month after month.
But other ADCs have shown good response rates in early trials. What makes TB40 uniquely valuable enough to justify the billions?
Two highly specific factors. First, it achieved these deep responses without needing biomarker selection. Usually, before you give an ADC, you have to biopsy the patient's tumor and test it to make sure it expresses a high level of the specific target protein. If it doesn't, the drug won't work. TUB40 worked across a broad spectrum of patients regardless of their biomarker status, which massively increases the addressable market.
Okay. That's a big deal. And the second factor?
The safety profile. Because of that titanium P5 linker we talked about, they observed zero lung toxicity, specifically interstitial lung disease, and zero ocular toxicity. Both of those are severe dose-limiting side effects that have completely crippled the development of competing ADCs in the space.
Right. And Andrew Dickinson stated point blank that the financial return from the ovarian cancer market alone justifies the entire multi-billion-dollar acquisition price.
Okay.
He basically said, if this only works in ovarian cancer, we make our money back and then some. Any future expansion into lung cancer or other solid tumors using this P5 platform is just pure, unadulterated upside.
It is a calculated bet on a best-in-class biochemical mechanism. But they didn't stop with ADCs. They also just closed the acquisition of Arcelix, moving heavily into the cell therapy space to bolster their existing KITE division. Specifically, they bought an asset called anito-cel for multiple myeloma.
Cell therapy, specifically CAR-RTT, is arguably the most complex logistical undertaking in modern medicine. I mean, you literally have to extract a patient's own white blood cells, freeze them, ship them to a specialized manufacturing facility, use a viral vector to genetically engineer those cells to grow a chimeric antigen receptor, a CAR, so they recognize cancer, grow millions of these new assassin cells in a bioreactor, ship them back to the hospital, and infuse them back into the patient.
It's wild. It is bespoke, personalized medicine at an industrial scale.
And Gilead's Kite division already has industry-leading manufacturing capabilities for this. They can turn these cells around faster than almost anyone else in the world, which is critical because these patients are dying and cannot wait months for their cells to be engineered.
Exactly. So the specific market they are targeting with anito-cel is the fourth-line CAR-T market for multiple myeloma, which management estimates is valued at roughly $3.5 billion.
But I have to ask, what does a fourth-line multiple myeloma patient actually look like? Because there are already 2 approved CAR-T therapies on the market for this disease. Why does the world need anito-cel?
A fourth-line multiple myeloma patient is someone who has essentially exhausted all modern medical options. They have relapsed after treatment with immunomodulators, proteasome inhibitors, and anti-CD38 monoclonal antibodies. Their immune systems are battered, their bone marrow is compromised, and they are incredibly frail. When you give these frail patients existing CAR-T therapies, the engineered cells go into the body and attack the cancer so aggressively that it triggers a massive inflammatory response.
This is cytokine release syndrome, right? Or CRS. The immune system basically goes into overdrive, causing massive fevers and dangerous drops in blood pressure.
Exactly. But the more terrifying side effect is when that inflammation crosses the blood-brain barrier. It causes a condition known as ICANS, immune effector cell-associated neurotoxicity syndrome.
That sounds terrifying.
It is. Patients can experience severe confusion, loss of speech, seizures, and in rare cases, fatal brain swelling. It is the dark shadow hanging over all CAR-T therapies.
And this is where anito-cel differentiates itself. Why is anito-cel biologically different from the CAR-Ts already on the market?
Arcelix engineered anito-cel using a novel synthetic binding domain called a D-domain rather than the traditional antibody fragments used in older CAR-Ts. This D-domain is much smaller, it binds more efficiently to the multiple myeloma cells, and crucially, it seems to activate the T cells in a much more controlled, sustained manner rather than causing a massive, explosive cytokine spike.
So it's a slower burn.
Yes. In the clinical trials, anito-cel demonstrated deep, durable tumor eradication, but the headline finding was the safety profile. They observed absolutely 0 delayed neurotoxicities and 0 severe ICANS.
Wow. A clean safety profile in a heavily pretreated, fragile population is an absolute game changer. I mean, doctors hesitate to prescribe CAR-T because they are terrified of putting a frail patient in the ICU with brain swelling. If anito-cel removes that fear, it easily steals market share.
Exactly. And they're targeting a PDUFA date in December 2026, meaning they expect commercial revenue to start flowing in early 2027.
But the real financial upside isn't in the fourth line, is it?
No, not at all. Because of that incredibly clean safety profile, Gilead is already running the phase 3 IMagine3 trial to test anito-cel in earlier lines of therapy, specifically the second to fourth line.
And that is the holy grail of oncology development. The FDA will not allow a highly toxic drug to be given to a healthier second-line patient if safer alternatives exist. But if your drug is exceptionally safe, you can move it up the treatment paradigm. If anito-cel moves from the fourth line to the second line, the addressable patient population and therefore the revenue potential grows exponentially.
Exactly. So you see the strategy here. Buy Tubulus for the titanium linker in solid tumors, and buy Arcelix for the non-toxic D-domain in blood cancers. They are buying best-in-class safety profiles to dominate the market.
It's a massive play. Now let's pivot slightly because Gilead is quietly building moats in areas outside of HIV and cancer as well. We have to talk about liver disease and their new inflammation strategy. Let's start with the liver, specifically a drug called Livdelzi. First quarter sales of Livdelzi more than tripled year over year to $133 million.
Livdelzi is treating a condition called primary biliary cholangitis, or PBC.
I saw PBC in the notes, and honestly, liver disease feels like a strange pivot for a company historically known for infectious diseases like HIV. How does a drug that treats bile ducts fit into their broader corporate strategy, and what exactly is PBC?
It actually fits perfectly into their historical expertise in hepatology, which they built during their massive success curing hepatitis C a decade ago. So PBC is a chronic, slow-moving autoimmune disease. For reasons we don't fully understand, the patient's own immune system begins attacking and destroying the small bile ducts inside the liver.
Okay.
Bile is a highly toxic, acidic fluid used to digest fats. When those ducts are destroyed, the bile has nowhere to go. It backs up and pools inside the liver tissue, causing severe inflammation, scarring, and eventually total cirrhosis and liver failure.
Wow. So what does Livdelzi actually do? Is it an immunosuppressant?
No, it operates on a totally different pathway. Livdelzi is a highly selective PPAR delta agonist. It essentially goes into the liver cells and flips genetic switches that drastically reduce the production of toxic bile acids while simultaneously suppressing the inflammatory pathways causing the scarring.
And the market adoption has been incredibly fast. You noted earlier that Livdelzi has already captured over 50% of the U.S. second-line PBC market. Why did it capture half the market so rapidly when there were already generic and older treatments available?
Because the older treatments often cause severe, debilitating itching pruritus as a side effect. And itching is already a major symptom of PBC itself. Imagine having a disease that makes your skin intensely itchy, and the drug you take for it makes it even worse. Patients were absolutely miserable.
That sounds awful.
It was. Livdelzi not only improved the biological liver markers significantly better than older drugs, but it actually demonstrated a reduction in that severe itching. It was a massive quality of life improvement, so doctors switched their patients immediately.
And they aren't done in the liver space. They have a phase 3 study called Ideal reporting updates later this year, which could expand Livdelzi's label even further. They also have a drug called Hepcludex for chronic hepatitis delta virus, or HDV, which has been approved in Europe for years, but they're expecting an FDA decision and a US launch later this quarter. So the liver moat is deep and highly profitable.
Very profitable.
But I want to spend some time on their pivot into inflammation, because once again, they executed a major M&A deal here. They announced the pending acquisition of oral medicines.
Yeah, with this single acquisition, Gilead is effectively doubling its entire inflammation and immunology pipeline overnight. And the crown jewel of this specific deal is a clinical stage molecule called gamgertamig.
Gamgertamig. It sounds like a generic fantasy villain. Let's break down the biology here, because the transcript described it as a BCMA CD3 bispecific T-cell engager. What does that actually mean for the patient?
Let's unpack the mechanism, because it is brilliant. In many severe autoimmune diseases, the root cause is rogue plasma cells and B cells. These are the immune cells that normally produce antibodies to fight infections. But in autoimmune disease, they mutate and start producing autoantibodies that relentlessly attack the patient's own healthy tissue, whether that's the joints in rheumatoid arthritis or the skin or the kidneys.
So historically, how have we treated that? You just broadly suppress the entire immune system, right? You give them steroids or biologics that basically put a wet blanket over the whole immune response, hoping it quiets down the rogue cells.
Exactly. Which leaves the patient highly vulnerable to infections and requires them to take expensive injections for the rest of their lives just to manage the symptoms. Gamgertamig takes a completely different approach. It is a bispecific antibody, meaning it has two different binding arms. It acts like molecular double-sided tape.
One side grabs the target, one side grabs the weapon.
Precisely. One arm is engineered to bind specifically to BCMA, which is a protein found on the surface of those rogue autoantibody-producing plasma cells. The other arm binds to CD3, which is a receptor found on healthy T cells, the body's natural killer cells.
Okay, so it connects them.
Yes. Gamgertamig literally physically drags the killer T cell right up to the rogue plasma cell, forcing an interaction, and signals the T cell to annihilate the pathogenic cell.
So it's essentially weaponizing the patient's own healthy immune system to hunt down and assassinate the specific cells causing the autoimmune disease.
And this is where Gilead's strategy becomes so clear. They are explicitly moving away from chronic symptom management. They are aiming for something they call a durable immune reset.
I love that phrase, a durable immune reset. It implies you aren't just treating a disease, you are curing it.
That is the ultimate goal. By using gamgertamig to cause deep, profound depletion of these rogue B cells, you effectively clear the corrupted cells out of the bone marrow entirely. The hope is that when the immune system eventually repopulates with new B cells, it resets to a normal, healthy state without the autoimmune memory. You shift from a patient taking a drug every 2 weeks for 50 years to a patient taking a short course of therapy that resets their immune system for years at a time, or possibly forever.
That is a staggering commercial proposition. What diseases are they targeting first? Because autoimmune is a massive category.
They are starting incredibly smart. They are initially targeting orphan autoimmune indications, rare diseases with massive unmet medical needs. For example, a disease called pemphigus, which is a horrific condition where the autoantibodies attack the proteins that hold skin cells together, causing severe, painful blistering all over the body.
Oh, wow.
Yeah. In over 60 patients treated so far across various trials, gamgertomic has shown rapid, deep plasma cell depletion with very low toxicity. They are aiming to initiate phase 3 trials in these rare diseases as early as 2027.
But the long-term vision is much bigger than rare diseases, isn't it?
Absolutely. Management believes the mechanism of gamgertomic has potential applicability across more than 20 different autoimmune diseases, including massive markets like lupus and multiple sclerosis. It is a pipeline in a single product.
Okay, so we have covered a massive amount of operational ground. We've got the HIV cash cow funding the future. We've got the oncology ADCs with titanium linkers, the non-toxic CAR-T therapies, the liver disease moats, and the bispecific immune resets. Now it's time for the rubber to meet the road. Let's look at management's guidance and translate what this massive, sprawling scientific enterprise actually means for the balance sheet.
The top-line guidance they provided is extremely encouraging, and it reflects the operational strength we just discussed. Because of the massive outperformance in Q1, specifically that explosive launch of Yes2Go and the unwavering strength of Biktarvy, management actually raised their 2026 base business revenue guidance by a full $400 million.
Raising guidance by nearly $500 million after just one quarter is a massive signal of confidence. They are now projecting between $29.4 billion and $29.8 billion in base revenue for the year. That represents solid 5% to 6% growth compared to 2025.
But there is a vital piece of context hidden in those numbers that investors must understand. Management noted that their 5 to 6% growth projection actually includes a roughly 2% headwind related to policy changes.
Right, the government pricing pressures.
Yeah.
Can you explain how that impacts the top line?
It primarily relates to shifts in government drug pricing agreements, specifically higher statutory rebates required within Medicaid, and proposed pricing changes stemming from the Affordable Care Act. Essentially, Gilead is selling more volume, but the government is legally forcing them to accept a lower net price per pill in certain public health sectors.
So if you remove those external legislative pricing pressures, the actual underlying patient demand, the operational growth of Gilead's business would be closer to 7% or 8%. The fundamental engine is incredibly robust.
The cash is flowing in at record levels.
Which brings us to the massive, glaring contradiction at the heart of this earnings call. This is the paradox I brought up in our introduction. I'm looking at the guidance table. They raised revenue guidance. They expanded their gross margins to 87%. They are forecasting nearly $30 billion in sales. And yet, management is projecting a full-year non-GAAP loss per share, a net loss, between $1.05 and 65 cents per share. How is it mathematically possible for a company to generate $30 billion in high-margin revenue and tell its shareholders that it will lose money on the year?
If you are a standard retail investor, you screen a stock, you see negative EPS, and you immediately assume the company is failing, that their operating costs are out of control and they are burning cash just to keep the lights on. But that is fundamentally not what is happening with Gilead. To understand this red ink, we have to take a quick detour into the psychology of corporate accounting rules.
Please do, because a negative EPS on $30 billion of revenue breaks my brain.
It comes down to a specific accounting classification known as acquired in-process research and development, or IPR&D. When Gilead buys a company like Tubulus or Arcelix, they aren't just buying tangible assets like laboratories or patents for drugs that are already selling. They are paying billions of dollars for the potential of drugs that are still in clinical trials like TUV40 or anito-cel.
Right, they are buying unproven innovation.
Decades ago, companies used to take the billions they spent on these acquisitions and record them on their balance sheets as an asset, much like buying a factory. It made their balance sheets look incredibly strong. But the SEC and the Financial Accounting Standards Board, the FASB, stepped in. They enforce a principle called conservatism. They argue that until a drug successfully passes phase 3 trials and gets FDA approval, its actual commercial value is technically zero. It is purely speculative.
Because if a drug fails phase 3, you can't sell it. It's worthless. And if you had recorded a failed drug as a $3 billion asset on your balance sheet, you would suddenly have to write off billions of dollars overnight, which shocks the market and destroys investor trust.
Exactly. To prevent that kind of artificial balance sheet inflation, JAP accounting rules now force pharmaceutical companies to take the entire upfront payment for acquiring clinical stage drugs and expense it immediately as IPR&D in the quarter the deal closes. It is treated as an immediate, massive loss.
So across the 3 recent acquisitions we discussed, Tubulus, Arcelix, and Oral Medicines, Gilead incurred $11.5 billion in upfront payments and financing costs.
And under the rules of IPR&D, that entire $11.5 billion was instantly wiped off their profit ledger for the year. It hit the income statement like a meteor. That specific accounting rule translates to a massive one-time $9.50 per share expense. That $9.50 charge is solely responsible for dragging the EPS into negative territory.
It's a paper loss, not an operational failure.
Precisely. If you exclude those one-time M&A costs, which any serious investor absolutely should because they are strategic capital allocations, not recurring operational expenses like payroll or manufacturing the underlying, operational non-GAAP EPS remains incredibly strong. Management reaffirmed that excluding the IPR&D hit, their operational EPS is expected to be between $8.45 and $8.85 for the year.
Which is exactly in line with their original, highly profitable expectations. So the takeaway here is vital. Do not let a stock screener scare you out of this position. The underlying cash flow engine is roaring. In fact, that $400 million revenue beat we talked about earlier actually absorbed the increased operational costs of running the new clinical trials for these acquired assets.
And this massive spending spree is exactly why the CFO, Andrew Dickinson, made a point to signal a change in capital allocation strategy. He made it very clear that Gilead is officially pausing major M&A activity for the remainder of 2026. The shopping spree is over.
They bought the assets, now they have to build the house.
The focus has shifted entirely to operational execution. They have to integrate Kite's manufacturing with Arcelix technology. They have to run the massive phase 3 trials for the Tubulus ADCs. They have to launch the new inflammation programs. Management recognizes that they have strained their internal infrastructure by absorbing 3 huge companies in rapid succession, and they need time to digest.
But despite pausing M&A, they are still aggressively returning cash to shareholders. They paid out $1.4 billion to shareholders in Q1 alone. That included over $900 million in their standard high-yield dividend, plus another $400 million purely dedicated to stock buybacks. They are retiring shares, increasing the ownership stake of every remaining investor while paying them a massive dividend to wait for these oncology trials to mature.
They have essentially constructed a financial fortress. They are funding a high-risk, incredibly high-upside biotech pipeline using the ultra-reliable, high-margin cash flows of their dominant commercial businesses.
Which brings us to the ultimate synthesis of this deep dive. We have analyzed the supply chain quirks, we've broken down the biology of capsid inhibitors and titanium linkers, and we've decoded the IPR&D accounting mechanics. If a retail investor is staring at the ticker symbol GILD right now, how should they view this stock? Let's build the ultimate bull versus bear case based entirely on this earnings call. Give me the bull case first. Why should an investor buy Gilead right now?
The bull case for Gilead is rooted in the sheer dominance of their commercial foundation, combined with massive, fully funded future optionality. First, you look at the HIV franchise. It is an absolute fortress that generates predictable, recession-proof cash. Biktarvy owns 52% of the market and continues to grow. Yeztugo has proven to be a bona fide mega blockbuster out of the gate, and it is expanding the entire pre-EP market at 14% a year. The core business is effectively immune to macroeconomic shocks because these are life-saving, non-discretionary medicines.
Like, regardless of what interest rates do, patients will continue to take their HIV medication.
And what makes Gilead unique is what they are doing with that cash. A smaller biotech company with a promising ADC or CAR-T drug has to constantly dilute its shareholders by issuing new stock just to fund its phase 3 trials. Gilead doesn't have to dilute anyone. They have 47 active clinical programs across oncology, cell therapy, and immunology, all entirely funded by the HIV cash flows. They have up to 4 additional major product launches expected before the end of 2026 alone. The bull sees a legacy infectious disease company that has successfully and aggressively bought its way into becoming a diversified biopharma powerhouse, and the market simply hasn't priced in the upside of that oncology pipeline yet.
Okay, that is a compelling vision of the future.
Yeah.
But there are brilliant analysts on Wall Street who are heavily shorting this stock. Give me the bear case. What are the fatal flaws in that bullish thesis?
The bear case centers entirely on the exorbitant cost of external innovation and the immense risk of operational execution. Buying the future is outrageously expensive. Taking an $11.5 billion hit to the balance sheet for IPR&D is real capital leaving the company. It represents years of retained earnings wiped out in a single quarter to purchase unproven assets.
The bears argue they overpaid for Tubulus and Arcelix at the top of the biotech market cycle.
Exactly. And the second half of the bear thesis is execution risk. Gilead's management team has historically specialized in small molecule antivirals. Now, they suddenly have to successfully manage the most complex biologics and cell therapies on the planet. They have to integrate 3 distinct corporate cultures simultaneously, manage the explosive commercial launch of Yes2Go, defend their liver disease market share, and run dozens of complex phase 3 oncology trials all at once. That is a staggering strain on management bandwidth.
It's a recipe for drop balls and clinical delays.
And the ultimate risk in biopharma is the science itself. What if the ESMO data for TB40 was a statistical fluke and the phase 3 trial fails? What if a safer CAR-T therapy emerges before anito-cel gets approved? If the phase 3 trials for these multi-billion-dollar acquired assets fail to hit their primary endpoints, the FDA denies approval. If that happens, the entire $11.5 billion investment goes to zero. The capital is effectively incinerated.
You are buying the clinical trial risk profile of a volatile biotech startup, but you are paying the premium price of a mega-cap dividend stock.
Precisely. If the clinical trials stumble, Wall Street will ruthlessly punish the stock for squandering its HIV cash pile on failed science.
So, synthesizing both sides, the actionable reality for you, the retail investor, is that Gilead presents a fascinating, highly complex hybrid. On one side of the ledger, it operates like a deeply entrenched, high-yield value stock. It generates massive, predictable cash flows from its monopolies in HIV and liver disease, and it pays a hefty dividend while you hold it. But on the other side of the ledger, it is currently pricing in the extreme volatility of a high-growth biotech due to its aggressive pivot into ADCs, cell therapy, and immunology immune resets. If you buy Gilead today, you are buying a cash printing machine that is deliberately using a massive chunk of its profits to buy high-stakes lottery tickets in oncology.
It is a foundational dividend stock with a high beta, highly volatile pipeline grafted onto it. You have to be comfortable with the dual nature of that investment.
And that brings us to the end of our deep dive into the Q1 2026 earnings of Gilead Sciences. We have covered an immense amount of ground today. We've navigated the pharmacy inventory drawdown cycle. We've broken down the molecular architecture of titanium linkers and non-toxic CAR-T therapies, and we've demystified the accounting quirks of IPR&D. Our goal is to ensure that when you read a headline about a massive earnings miss, you actually understand the structural machinery causing it.
Because in the biopharma sector, knowledge is only actionable when you actually understand the biological and financial mechanisms driving the numbers.
We spent the last hour dissecting billions of dollars in M&A, complex accounting rules, and PDUFA dates. It is easy to get lost in the spreadsheets and the corporate strategy. But when I look back at the source material, specifically Dietmar Berger's update on the Purpose 365 trial, that once-a-year injection for HIV prevention, it makes me realize that Gilead isn't just trying to fundamentally change its balance sheet. They are actively trying to end an entire era of human behavior.
The era of the daily medicine cabinet. I mean, for decades, the entire pharmaceutical industry and the patient experience has been built entirely around the daily pill.
Exactly. Adherence to a daily pill isn't just a medical requirement. It is a psychological burden. Taking a pill every morning is a daily physical reminder of your mortality, your condition, and your risk. It anchors your identity to your disease. But if Purpose 365 succeeds, and a patient only has to interact with their healthcare provider once every 365 days to receive a single invisible intramuscular injection, the entire psychology of being a patient begins to dissolve.
It forces us to ask a profound question about the future of medicine. How will human behavior change when treating or preventing chronic, life-threatening conditions no longer requires a daily routine? When managing a complex disease feels less like an ongoing medical battle and more like simply getting your annual flu shot? The adherence rates will skyrocket, but the psychological relationship between humans and their own health will be fundamentally rewritten.
The psychological shift of leaving the daily pill behind could be just as profound as the medical breakthrough itself. It's a fascinating future to consider. Thanks for taking this deep dive with us, and we will catch you on the next one.